Good morning, everybody. Thank you so much for coming. And I'm Jordan Roy-Byrne. My newsletter is called The Daily Gold. You can find all my work at thedailygold.com. Okay, and what I'm going to be talking about in my presentation today is how gold stocks are really setting up for a huge move higher over the next 12 to 18 months. My past presentations here, I haven't always been that bullish. I can't recall being bullish. I was waiting for the market to get in position for that big move. Before May and before that, I was talking about how the real key and when the market would move would be when the Fed shifted policy and cut rates. And when I gave my presentation in May, it looked like that was still, 3, possibly even 6 months away. But it happened in less than a month. So things can change quickly. But I like the track that we're on. We're setting up for, I think, what's going to be a really good year in 2020. I'm going to talk about why in this presentation. So if you're here for the whole day, you're going to see hundreds and hundreds of slides. You're not going to remember everything. You're probably going to, probably only going to remember like 3% of what you see anyway. So that's why there's the 3 important points for where we are. Again, I already said it. We have a very bullish setup in place for the next 12 to 18 months. Possibly it extends deep into 2021. I don't know, but it just looks like over the next 12, maybe 18 months, we have a very bullish setup for gold stocks. And talking about fundamentals, either macro outcome, there's really 2 outcomes that we could have. They favor gold. And that's why I think either way we're going to see gold stocks make this huge breakout and the sector is going to trend higher. Lastly, where we are here and now, we're still in a correction and consolidation. So the market is not ready yet to begin that huge move higher. As far as when that could happen, nobody knows. It could be a couple months, it could be 5 months. We don't know, but we're still in a correction consolidation. So I'm going to talk about that moving forward. Okay, so let's talk about the setup that's in place for the next 12 to 18 months. And here we have weekly charts of GDX at the top, GDXJ at the bottom. These are weekly bar charts. And what we can see is, specifically with GDX, so in 2016, GDX rallied up to this resistance. It pulled back. That was a pretty big pullback. But it did it again. And where we are here and now, so far the pullback has been pretty shallow. It's been 2.5 months. I'm going to get into more internals and how things are acting. But I really like how it's acting. As long as it holds above 24.25, I think it's going to continue to stay in this range and get ready for that big breakout. Sometime next year. GDXJ is a little bit behind, but assuming if and when GDX takes out 31.32 and begins that breakout, GDXJ is not going to be that far behind. Its major resistance is a little bit below the 2016 peak, and then it'll have to deal with the 2016 peak. But again, if and when GDX makes its breakout, then we're going to see GDXJ do the same. So very bullish technical setup. The setup is in place for a huge move higher, and that isn't always the case. This is, the next, again, 12 to 18 months, that could be a real special time for us here in the gold stock sector. And so let's talk about fundamentals and macro. Really, either outcome is going to favor gold, and what I mean by that is, if we get some kind of reflation here and inflation might become a little bit of an issue, we don't have a recession in the next year, that's going to favor gold because the Fed is not going to hike rates. That's why. Now, the other scenario is if we don't get a reflation, the Fed is in pause mode right now, but if they have to cut rates again and cut rates a couple times, we know that's really bullish, so that favors gold. And what I'm looking at here is the yield curve, stock market, and gold. So we have the yield curve, and then we have gold divided by the S&P 500. And, this is actually the Fed funds rate. And So the real fundamental driver for gold is real interest rates. It's falling or declining real interest rates. And another way to look at that, it's just easier for me to explain, is the yield curve. And so what is bullish for gold is steepening. It's this move, after it goes inverted and then it steepens. And so looking back over the past 25 years, we can see these two examples, what happens where things roll over, the Fed starts cutting rates here, they start cutting rates again, and then gold divided by the S&P 500, that moves off its bottom, trends higher. It happened here again. Now, okay, what happened here in 98 and also here in the mid-90s? Precious metals, we did have a good run in the mid-90s, but what happened was they cut rates a couple times and then they stopped. Same thing happened here. They cut rates a couple times, they stopped, they were able to hike again. And so that's why we had a little move here and then it went back down. Here, was stabling, but the larger trend was down, so it went back down. So the bearish case I see people trying to make it, they're not gold bugs per se. The bearish case is this is the late 90s or it's the mid 90s. And so what that entails is things are going to turn around and the Fed's going to be able to hike rates again. And we know that's bullshit. That's not going to happen. Things might turn around, but the Fed's not going to hike rates again. I don't think there's any chance that the economy can strengthen that much where the Fed is actually going to be able to hike rates. But still, we're still here in gold to the S&P 500 ratio where it hasn't broken out yet. We've had, 3 rate cuts. So there's still some doubt in the market, and the yield curve hasn't fully steepened. And so, again, what we need to see for that full steepening, we need to see a second round of rate cuts, or we need to see inflation takes off, the Fed lets it go, and so they don't hike. And then you would see this ratio break out to the upside. You see more steepening here. That obviously would be very bullish for precious metals. Okay, and so let's talk about the inflation scenario where we kind of get this little reflation going next year. There's no recession, and inflation goes up a little bit more. But in that environment, we know the Fed is not going to hike rates. And so that could entail rising inflation expectations. And here, this ETF, RINF, it's an inflation expectations ETF. So they're trying to capture rising inflation expectations. And I show here what happened from beginning of 2016 through 2018. And inflation expectations were rising. You can see the CRB commodity prices, they were rising. TIPS, they were also rising and stable at the end of that period. But look at the yield curve, what happened. It was steepening a little bit because we had inflation taking off. And throughout, the Fed did their first hike here at the end of 2015, but then they didn't hike again until the very end of 2016. And that's why this was steepening, the curve was steepening, because inflation was rising, long-term yields were rising a little bit, but the short end was not rising because the Fed, they paused for a full year. And so, during this period, 2017 and 2018, other like base metals did really well. So other commodities, they were making higher highs. So that was not a good time for precious metals. They were not making higher highs. And remember, gold was going sideways, silver trended down, the gold stocks trended down. And so yes, there was rising inflation expectations in this period, but so why didn't gold and precious metals do well? Well, that's because the yield curve flattened because the Fed was hiking rates. So if we go to this scenario of rising inflation expectations over the next 12 to 18 months, it's bullish for gold as long as the Fed is not hiking. If the Fed was hiking, we would see the yield curve flatten again. And so that's the big difference between potentially the next 12 to 18 months if we get rising inflation expectations again versus what happened in mostly 2017, but also 2018. Again, the yield curve flattened. Precious metals did not do well because the Fed was hiking. If we see a repeat of this scenario, the Fed they're going to stand pat. They're not going to hike again. Now, here what I want to discuss is the gold stocks and the stock market in the 1960s. And if you follow my work, you know that I constantly harp on we need to see gold outperform the stock market. Gold has to outperform the S&P 500. We need to see the stock market roll over. The Fed has to cut rates. Therefore, gold stocks, we're going to move higher. And I talk about the negative long-term correlation. I mean, historically, we all remember the 1970s and the 2000s. Most of that time, there was a long-term negative correlation between precious metals and the stock market. But this move that we've seen recently in precious metals, the breakout in gold stocks have done very well. It's been alongside the stock market, so that concerns me a little bit. But this actually happened in the 1960s. So gold was fixed then, as we know, but the gold stocks were not. So this is the Barron's Gold Mining Index that I'm tracking here. It's right here. And this is just gold stocks against the stock market. And by the way, if you've read my new book and you've listened to my past presentations, I think just generally macro-wise, we're in the early 1960s. So that period, it fits super well with what's going on now. And I think we're at the start of, well, not at the start, but we're going to see inflation, we're seeing a secular low in inflation. It's going to rise over the next 15 to 20 years. I don't know if it's already begun or if it's going to really begin in like 3 to 4 years. But the real important takeaway is that where we are right now is very similar to the early 1960s. But back on the micro topic here, look at gold stocks. We had this historic low in 1957, which, by the way, that's, in my opinion, and from what I've looked at, that's equivalent to the low we had in January 2016. And so gold stocks trended up here in the first few years of the 1960s, but it was right along the S&P 500, and gold stocks were not outperforming the S&P 500. This ratio was going sideways until I believe 1965 or so. And then when this breakout happened, gold stocks really accelerated. Here's where that started. I believe that's 64. But anyway, so this is where it started. And from here, we had that's the percentage gain. We had a huge move higher from here up to there. I mean, massive gain. And from here, this is when gold stocks really started to outperform the S&P 500. So, I mean, look, even after that point, when gold stocks were outperforming the S&P 500, look at this, these last few years on the chart. The S&P kept rising. I mean, it had this quick bear market here, but it kept rising, it kept making higher highs. So, I mean, the takeaways from this are, number one, the gold stocks can still rise and do well, even if the stock market is rising. The second takeaway is, but for gold stocks and precious metals to really accelerate and have that huge move, at some point they need to outperform the stock market. Okay, so where we are here and now, we're still in a correction consolidation, and I'm going to get into a number of charts and kind of give you what's going on right now. Here we have, this is the weekly chart of gold. This is the COT. It's the net speculative position divided by open interest. So I measure it as a percent, and that gives me this clean look over time where I can see, look, normally when it gets up to 55 or 60%, those are peaks. Now, so gold is holding above 1450. I think it's going to probably come down to 1400, maybe the high 1300s at some point. A 200-day moving average, not shown here, is 1393, 1394, something like that. So look for a little bit more downside in gold. And a big reason why is, let's go back to the early years of this bull market, specifically 02 to 09 or so. Now, I marked here when we had interim peaks in gold. After these peaks, looked what happened to the net spec position. You can see peak here, it comes down to 30%, a little bit below. Peak here, down to 20%. Another peak here, below 20%, 20%. Peak here, it's below 30% in the 20s. After the GFC, it came down here below 30%. So we're at 43% right now, 42.6% to be precise, as of the data as of Tuesday. So, we're in a new bull trend, we're in a primary uptrend, but this tells us odds are more likely than not, it's probably going to come down to 30%, maybe a little bit lower. So there's still too many speculators in the gold market. They need to be cleaned out. They need to be cleared out. So we've seen a little bit of that recently, but we need to see more. So I'd like to see gold come down to 1,400, 1,390. That'll flush out more specs, and then so sentiment will it'll improve from the bullish standpoint. But that's where we are here and now. So this is my big bugaboo right now. Too many specs in the market. More time is required, so more weakness to clear them out before the next move higher. But I do want to focus more on, and we all should right now, we should focus more on the miners, gold stocks specifically, because they're starting to outperform gold. And I think this next big move, they are going to lead it higher. I think GDX is going to take out this resistance at 31 before gold takes out 1550 again. So I would watch GDX as a leading indicator more so than the price of gold. And so here we have GDX. This is the advanced decline line for GDX. And what we're measuring here is basically every day, how many stocks in GDX are rising versus how many are falling. So this is a powerful leading indicator. It's a breadth indicator. It tells you, how many stocks are really participating, in the move, whether it's up or down. You can see this was super weak during the bear. This is an excellent leading indicator right here. At the beginning or the end of 2018, this was the only false signal. I was too concerned. I was saying, look at the AD line. It's giving a negative divergence. Look, nothing is foolproof. Nothing works perfectly all the time. But most of the time, you can see here, it really has worked. And just in the last couple months, so we're having this little correction. Look at what the AD line is doing. First, it has higher lows, so that's a positive divergence. GDX, slightly lower lows, higher lows in the advanced decline line. And also, right now, it's pretty close to making an actual higher high well before GDX. And in fact, go back to October 30th, the advanced decline line made a higher high, even just for one day, so it made a higher high. GDX is not even close to making a higher high. It's not close to 31 or breaking above it yet. So this is, again, the correction may continue for a couple more months. I don't know, but this leading indicator here is much stronger than GDX. That's what we want to see. So that's very encouraging. And some more encouraging things here. We have, so we're looking at GDXJ, which is really the senior juniors or the larger juniors. So we have GDX here. We have GDX divided by the gold price here, and GDXJ divided by GDX. And what we can see is, the GDX has been trying to stabilize here. It could go a little bit lower if gold goes to 1,400. But if we look at these ratios, look, GDXJ right here, this is a positive divergence. It's starting to outperform GDX. That's very encouraging. And also, it's starting to outperform gold by just a little bit. So again, we're in a correction. The things should kind of be weak. You shouldn't be seeing GDXJ being stronger than GDX, and silver stocks, they're holding up better. I'll get to that. We shouldn't be seeing these things in a correction. But the fact that we are, that tells us, the market is stronger than we think, and it's really getting ready for that next big move, whether it happens, in the next month or two, or if it's 4 or 5 months. So main takeaway here is GDXJ, it's outperforming GDX. Again, very encouraging. The silver stocks, SIL, I know this isn't a huge ETF, but look right here how, we just saw gold and silver, they made lower lows last week, or this past week, and look at where SIL is compared to its recent low. This isn't even close to breaking its October low. It's well above it. So, that's relative strength from the silver stocks. Here we have the silver stocks against silver. This ratio over the last couple months, it's made a slight higher high as the market has been correcting. And also, look at SIL against GDX. So silver stocks against gold stocks. Normally when we're in a correction, the silver stocks would underperform the gold stocks. This ratio made a higher high. Look at that. It's still below its 200-day moving average because gold stocks have been outperforming for several years. But again, in the very short term, the silver stocks are showing a lot of relative strength. That's a very good sign. It's really encouraging. And looking at, next, looking at silver, this is really the key trend line for silver. I'm going to go a little bit faster here because I don't want to go over my time, but this is the key trend line for silver. The key levels are 24 and 27. There's really no resistance from 24 to 27. So, when GDX makes that big breakout, silver will probably follow. Silver, it looks like silver needs more time to correct and consolidate. The key support is right around 16, maybe a tiny bit below. So silver, I think it's probably going to continue to lag for a little bit. But I mean, one trade idea is when we see GDX make that huge breakout, silver is probably going to follow that. So when we get that huge breakout, then you could consider going long the 3X silver ETF, because again, GDX breaks out, silver will probably follow that. It'll break out. First target is 2021, and then after that you have 24 to 27. This is another chart. This is where silver is right now. This is looking at all the historical rebounds in silver. And, we don't know what's going to happen, but this just gives us an idea of what history says. So, I mean, over the next 8 or 9 months, there's potential where we could see silver trading around these levels. And here's gold. And I've seen a lot of analog charts for gold, kind of comparing 20, like the low in 2016 to 2000 and 1971. It doesn't really fit that well. I mean, the best comparison for where we are is the 1960s, and of course, the gold price was fixed. So it's hard to find a good comparison for gold, but this is the best one, and that is basically comparing the 2012 peak in gold to the 1996 peak. I like that comparison because in 2003, when gold broke above 300, it made a 6-year high. So that's very similar to the recent breakout that we had. So, this is a fun chart, and this just shows if it continues on this path, where it could potentially go over the next year or two. Okay, so just a couple more slides and just a couple other things. I mean, I've mentioned these in my presentations over the last year or so. And this is what I was talking about before we got the rate cuts. I was talking about this at the end of 2018, early 2019. So if you look at in 11 of the past 13 rate cut cycles, the average gain for gold stocks is 172%. So, I mean, this is old news if you've seen my past presentations. But if we measure from the low, and if we measure from the, I believe it's the October low from 2018, this still would have GDX going to 4750. The measured upside target, I didn't mention it, but if and when GDX takes out 31, the measured upside target is about 50. So this history fits pretty well with that. And also this history as well, this is what I call a mega bear market is something that's down 80%. And basically it lasts like 3 years or more. It's down over 80%. And so these mega bear markets, they've followed a very similar pattern, which is you have a huge bear market, and then when the bear market ends, you get a really sharp rebound. But then after that rebound, the market kind of consolidates for like a year, 18 months before the next leg higher. So the gold stocks, this is another thing. They fit perfectly with this. They've followed this is, here's a bear market, first rebound, then the correction after the rebound. So they fit really well with this history. And what I want to point out here is this, you could see mortgage, first rebound was 194%, 194%, 165, then 200%, 137, 170. So, I mean, you can all understand, other than the recovery after the Great Depression, all these, the second leg was stronger than the first leg. So, I mean, the first leg in GDX was 150%. If 175%, where would that go? That would be 48 in GDX. So that's two things that target 48. The measured upside target from the breakout, again, that's 50. So this is the last thing to take away. This is the gold stocks against the stock market. And I'm using GDX, but if you look at the historical indices, then right around here in 2015, this was a 90-year low in this ratio. So we have a huge double bottom here that's very bullish.
But we need to see this ratio get above this resistance line. So the stock market is doing well. Gold stocks are correcting, so the ratio is coming down. It'll probably come down, consolidate a little bit more. But whenever we see this ratio start to rise again and get up to this red line and then go above it, that is probably going to be at the same time when GDX is, breaking above that major resistance at 31. Okay, so I'm almost done, but the last couple things, just remember all these things. Number one, we have a very bullish setup in place. We're still in a correction consolidation, so we're not ready to break out yet, but we do have a very bullish setup in place over the next 12 to 18 months. Fundamentally, either macro outcome is going to favor gold, whether the Fed has to cut rates again or we get some reflation, they're not going to hike rates. So either outcome, either way we're going, really favors gold. I'm only talking about the next 12 months. I'm not talking about after that. That's a whole nother presentation. Finally, because of this really bullish setup, you should sign up for my newsletter. This is extremely important, the most important thing probably. Sign up for my newsletter. But honestly, I was thinking about how bullish I am because normally I'm not. And you could sign up for every newsletter here, I think for $500 or $600. So what you should do is first sign up for my newsletter, and then secondly, sign up for everybody's newsletter and talk to all of us. And when you sign up for all our newsletters, find out I want your top 2 or 3 best ideas. Don't give me your number 12 or your number 9 pick. Jordan, I signed up. Tell me your top stocks. Give me your 2 or 3 best ideas. So you should sign up for every newsletter and do that and get the best ideas from everyone. So with that, I think that's it. I know I went a little bit over. I'm sorry, Matt. But thanks everybody for attending. I really appreciate it. And next up, we're going to have Greg McCoach and his companies.